everyone. It is election season, and that means we are getting a lot of questions from our clients and plan sponsors and plan participants about what they should do with their investments now that we are getting so close to the presidential election. So today I wanted to take a few minutes and talk about some of the great information that we received from our friends at Principal Financial Group about their thoughts on the upcoming election. So the first thing when we look at the presidential election, honestly, we treat this as we would treat any other event in the market. It is important that you look at your investments and that you choose investments that are appropriate for you based on your age, your risk tolerance, and where you are in whatever stage of life you may be. And it's important that you're not going in and trying to time the market. It is very difficult to do that. I say this all the time, but people who say they've timed the market just got lucky, to be honest. So when we look at the importance of staying invested in today's market, it's important to look at the difference between perhaps your political affiliation. I know a lot of times when we get calls from people, they'll say, well, if this person gets elected, then the market's going to tank. But then the next call will be for the other candidate, that if they get elected. And what we've seen on the chart below is that it really doesn't make a difference whether the candidates are Democrat, Republican. It really, you see very close to the same investment returns regardless. So when we look at the chart below, if the Republicans have full control, the average annual return that they have seen is about 10.4%. Democrats with full control is about 11.9%. When you have either party at full control, the average is about 11%. And when you have a divided government, it's about 10.4%. So really within that 1% frame is what we're looking at. So again, I wouldn't get too concerned about either political party winning or losing. At the end of the day, the rates of return tend to stay pretty consistent. But the important thing is that chart on the right. And if you look at if you strictly voted for one political affiliation or the other and got out of the market when the other took control, again, your rates of return are going to be fairly low. But if you stayed invested the entire time, your rates of return are going to be significantly higher than if you tried to time the market and pull out your money when a particular political party was in office. The next thing that we want to look at is staying invested and not letting those political beliefs cloud your judgment. If we go back to the 1940s, when President Truman was in office, and looked at the different presidents that we've had all the way up to President Trump, you'll see that, you know, on the long term, we've just continued to see the markets continue to grow. When we get to President Trump, we have, you know, the drawback that we've had in March of this year, but keep in mind that's recent history. I'm sure when we look at history going forward, and you have a longer time frame, this is going to look like more of a blip instead of a long turnaround. But in any event, when you look at all of the presidents that we've had since President Truman, again, you see a pretty consistent habit of the markets just continuing to increase over time. So again, it's not something to be overly concerned with one party or the other. What we've seen over time is that at the end of the day, both of the parties have managed to grow the economy and the stock market, and that's the important thing. And finally, we want to touch on volatility. One thing that we see in presidential election years are quite a bit of market volatility. You'll see that here, that most of the years that we've had, these are all of the presidential years going back to 1944. In every year except for two, we've had positive returns. So while we do experience quite a bit of volatility, more years than not, we do have positive returns as we get to the end of the year. You'll see the two exceptions are 2008, when we were in the middle of the financial crisis. We saw a 40% loss for that year. And in 2000, when we saw the tech bubble burst, we saw a negative 2% for that year. But with all of those other years, all of the other crises that we've experienced as a nation, at the end of the day, the markets have rebounded well and ended up positive with the exception of those 2 years. So again, as we start to hopefully wrap up this election season, as we inch closer towards November, again, we just want to remind you that it's important to stay invested. If you do have questions about your investment selections, please feel free to reach out to us. We're more than happy to answer any questions that you have. Have a great fall. Enjoy the more cooling temperatures, and we hope that you and your loved ones are staying healthy and safe. Thanks a lot.